Hello, friends. Welcome to OAWA's weekly update on money and economy. We begin with news on the US economy and interest rates. The 10-year US Treasury benchmark last week briefly touched 5% for the first time since 2007. To put this in context, during the COVID pandemic, the yields had crashed to a low of 0.5% in early 2020. Continuous hikes in key rates by the Federal Reserve, reversal of its earlier bond buying program, supply concerns on US government's borrowing program, and strong US economy have all been key factors. The Federal Reserve Chairman Jerome Powell has also recently commented that the US economy's strength and continued tight labor markets could warrant further Federal Reserve interest rate increases. He also noted recent market driven increases in bond yields that have helped to significantly tighten overall financial conditions. US Treasury yields serve as a benchmark for credit pricing in US and as well as impact other global and emerging bond market interest rates. Moving on to news on the Indian economy, two international organizations have underscored the growing importance of the Indian economy globally. Last week, the S&P Global said that India is likely to overtake Japan to become the world's third largest economy with a GDP of 7.3 trillion US dollars by 2030 and the second largest in Asia. India's gross domestic product (GDP) is expected to grow 6.2 to 6.3% in the fiscal year ending March 2024, being the fastest growing major economy this fiscal year. Separately, the IMF, that is the International Monetary Fund, said last week that China and India are projected to jointly contribute about half of world growth in both 2023 and 2024. India's share in this is 16%, and the remaining is contributed by China. According to the IMF, India has made significant strides in the area of digitalization and beefing up infrastructure. But beyond that, there could be structural reforms aimed at improving the business environment, labor reforms, and removing trade restrictions. All these go into building an environment which will support growth. Moving on to news on the domestic bond yields, India's 6-month and 1-year Treasury bill yields have moved upwards in a range of 710 to 715 as per recent weekly auction cutoff yields declared by RBI. Market participants feel the rates may remain in this band as banking system liquidity deficit, which is measured as the amount banks borrow from RBI's overnight lending facility, is hovering around Rs 1 lakh crores. The spread between the 1-year T-bill and 10-year government security benchmark is quite narrow currently at around 20 bips only, signaling a flat yield curve. Moving on to news on credit, as per recent news reports, there has been a significant increase in personal loans in India, particularly loans under Rs 10,000. The number of such loans has increased from 23.5 million accounts in the financial year 2019-20 to 65.6 million accounts in the financial year 2022-23. That is an increase of nearly 180%. This surge may be one of the reasons RBI has recently warned banks on the growth in personal loans, as any widespread defaults can cause rise in NPAs, that is non-performing assets, for banks and NBFCs. While the overall NPA situation in the banking sector has improved to a decade low, challenges persist in the small loan category. As of June 2023, the NPAs for loans below Rs 50,000 surged to 8.1%, marking nearly 6 times the NPA levels of 1.4% for all retail loans as of March 2023. It remains to be seen if RBI will bring in tighter prudential norms for such unsecured small personal loans. And finally, we end this week's update with regulatory news. SEBI, the financial markets regulator, has turned its lens On social media, finfluencers, particularly those with millions of followers on YouTube, luring the general public with promises of high returns and quick profits in the stock market. One such is Mohammad Nasaruddin Ansari, who runs Bap of Chart on social media platforms, where he used to offer buy sell recommendations in the stock market in the garb of providing educational training related to the securities market. SEBI has barred him from the securities market and also asked him to pay rupees 17.2 crore gained unlawfully from carrying out investment advisory activities which were both unregistered and fraudulent. It is important that as investors we be careful of whom we trust and take advice for trading. Ensure that your advisor has the relevant SEBI registrations, educational qualifications, track record, and credentials before you commit any serious money in any asset class. On that note of caution, that's it from us this week. Please click like, share, and comment if you liked our content, and do visit our website www.oava.in for information on our courses. See you next week.